95% of traders lose money, and the real reason isn't what you've been told. You've heard that statistic so often it probably feels numb by now, almost meaningless. But stop and actually think about it. If nearly everyone is losing, then almost everyone is thinking the same way. And that way, it's fundamentally broken. This isn't about intelligence, effort, or luck. Most traders don't fail because they're careless. They fail because they walk into a game they don't truly understand, armed with a mindset that turns them into easy targets from the very beginning. In this, we're not chasing magic indicators or secret chart patterns. We're pulling back the curtain on why most traders lose, how smart money quietly feeds on retail behavior, and what you must shift in your thinking if you refuse to be part of that 95%. Let's start where it all begins, the retail mindset. Picture this. A new trader opens a chart and instantly their brain starts firing familiar signals. Price breaks above resistance, that's a breakout. I need to buy. RSI dips into oversold, a reversal is coming. I'll go long. A big bullish candle closes, finally, confirmation. It's safe now. It all feels logical, clean, textbook. But here's the uncomfortable truth. The market doesn't reward what feels safe. In fact, those obvious levels, those clean signals everyone sees, are often the exact zones where larger players are waiting in silence, offloading positions or building new ones. While retail traders are celebrating confirmation, professionals are asking something entirely different. Who just got trapped here, and where is the liquidity? Because the issue isn't the tools. Support and resistance, RSI, candlestick patterns, they're not the enemy. The problem is how they're used. Most traders treat them like traffic lights. Green means go, red means stop. But the market isn't that simple. These tools are just fragments of a much bigger narrative. And when you think like the crowd, you trade where the crowd trades, and you get stopped where the crowd gets stopped. Price doesn't move because you're right. It moves because someone bigger than you found enough orders to execute against. Now, imagine a large player trying to build a massive position. They can't just hit buy and call it a day. That would spike the price against them and ruin their entry. They need liquidity, and liquidity is nothing more than other people's orders. Stop losses, take profits, breakout entries, all clustered at predictable levels. Where do these clusters sit? Right below obvious swing lows where everyone hides their stops, right above clean, equal highs where breakout traders place their buy orders, around those perfect textbook signals where retail traders react in sync. So when you see price suddenly dip below a low and then snap back, that's not random chaos, that's liquidity grab, the market diving into a pool of sell stops so bigger players can buy from forced sellers. And if you don't understand where liquidity lives, you're not trading the move, you're fueling it. Even when traders begin to grasp structure and liquidity, many still fail. Why? Because their emotions are still in control. FOMO drags them into trades right when the move is exhausted. Fear forces them to cut winners short and cling to losers. A streak of wins inflates their confidence, pushing them to risk more than they should. Then doubt creeps in at the worst moment, freezing them when a valid setup finally appears. They think the solution is a better indicator. It's not. What they actually need is a better relationship with uncertainty. The market is not a place of certainty. It's a game of probabilities. No setup is guaranteed. Losses aren't personal. They're operational costs. The real damage begins when you react emotionally to those losses, jumping strategies, chasing random trades, trying to win it all back quickly. Without a defined system and rules you commit to in advance, the chart becomes a mirror reflecting your emotions, and the market is brutally efficient at monetizing emotional behavior. Then there's the obsession with surface-level price action. Most traders zoom in to single candles like they hold the answers. That's a hammer. It must reverse. That's an engulfing candle. The trend is changing. Yes, candles tell a story, but only within context. A bullish candle floating in the middle of nowhere is meaningless, but that same candle forming right after a sharp stop run below a major low during a high liquidity session, that changes everything. The real questions aren't what is this candle called? The real questions are where is this forming? Did price just sweep a key level? Are traders trapped on the wrong side? Is price moving towards a known pool of liquidity? Without context, you're just reacting to shapes. With context, you're reading behavior. Now let's talk about something most traders completely lack: a real process. For many, trading looks like this. Open the chart, scroll around, spot something interesting, jump into a trade, adjust the stop loss because it just needs more room, watch the profit and loss fluctuate, then exit based on fear or greed. That's not a system, that's pure reaction. A professional approaches the market very differently. Before the session even begins, they already know which markets they're watching. They've marked key daily and weekly highs and lows. They've identified where liquidity is likely resting. They've mapped scenarios. If price sweeps yesterday's low during London and shows rejection, they're looking for longs. If price runs above last week's high and stalls, they're watching for trapped breakout buyers. And when they enter a trade, everything is already defined: the entry, the stop loss, the risk, the target. No guessing mid-trade. No bending rules just this once. They're not predicting, they're executing a plan based on probability. So how do you shift from randomness to having a real edge? First, simplify. Pick one framework and commit to it. Stop bouncing between strategies every week. Choose a structured way to read the market and stick with it for a meaningful sample, 50, even 100 trades. Define your time frames. Define how you mark key levels. Define what qualifies as a valid setup for you. Second, focus on location over signals. Don't just ask, is this bullish? Ask, is this the right place? Did price sweep a key level? Is there liquidity nearby? Because if the location is wrong, even the cleanest setup is worthless. Your edge isn't just the pattern, it's the pattern in the right context, at the right place, with controlled risk. And that brings us to risk. You don't control how far price will move in your favor, but you fully control how much you lose when you're wrong. That means risking a small, fixed percentage of your account per trade, placing your stop where your idea is invalidated, not where it feels comfortable. Accepting that small losses are part of the game. Survival comes first, always. Refinement comes after. And that refinement happens through journaling. Most traders don't review their trades properly. They remember how it felt, not what actually happened. But when you document everything, screenshots, setups, emotions, outcomes, you start seeing patterns. You discover which setups truly work, which times hurt your performance, and how often you break your own rules. That's when trading stops being random and starts becoming a skill you can refine. Now step back and look at the full picture. Traders don't fail because the market is impossible. They fail because they approach it like everyone else. They chase signals without context. They ignore liquidity and end up becoming it. Their emotions override whatever rules they have, if they even have rules. They focus on candle names instead of understanding structure. And they trade without a process, reacting to every tick. If you want to escape the 95%, you have to think differently. See the market as a hunt for liquidity, not just moving price. Trade behavior and location, not just patterns. Build a simple system and execute it with discipline. Control risk before chasing profit, and refine your edge over time through consistent review. You don't need to predict the future. You need to understand the game. Be selective. Manage risk with precision. Let probability work in your favor. And most importantly, stop volunteering to be the liquidity.